All right, well, I waited until Friday to do this report. We normally do it on Thursday because I wanted to get the data for the Consumer Price Index, which we got this morning, and it was good news. And we are seeing a nice move lower in interest rates as a result. Let's dive right in and look at the numbers, y'all. Mortgage News Daily has a 30-year fixed rate conforming loan today at 6.04%. That is a 30-day low on interest rates. We saw that same rate back on the 15th of January, so nearly 30 days ago. 1 week ago, we were at 6.15, and 30 days ago, we were sitting pretty low as well. We were at 6.07, so not a huge move over the last 30 days, y'all. We certainly haven't retested anything near the fives on a 30-year average just yet, but that may be around the corner, so we're going to talk more about that. Bureau of Labor Statistics is the reason that we saw bonds sell off pretty badly on Tuesday. Now, this was the delayed report due to the short government shutdown that we had. We didn't get it 2 weeks ago Friday like we normally do, so it was delayed a bit, and it came in much stronger than expected. It came in at 130,000 new jobs. Y'all, that's, I think, almost triple what the expectations were for this report. And the reason that the market is completely discounting it is if you look at all of 2025, y'all, we only added 180,000 new jobs in the most recent revised estimates of 2025 employment. The notion that we added 130 in 1 month when we only got 180 for the entire year last year, the market's just not believing it, y'all. It would be nice if we had better methodology at the BLS. It would be nice if they were impervious to political winds. I don't think they're either of those things. I think they are moved politically, and I also think that they use flawed models to get to the numbers that they produce. You know, we had over 60% revisions to the monthly reports that were provided last year to get to that all-in number of 180,000, and it's still likely to get revised lower. If you look at the base numbers that went into this BLS report, there were over 2.5 million job losses going into this report, but when you adjust them using these very flawed, in my view, algorithms that the BLS applies, that's how you got this 130,000 plus side jobs. It's not real. The market doesn't think it's real, and that's why the market only sold off briefly on Tuesday and then quickly recovered. And then that takes us to this morning's CPI. This was much better than expected, y'all. We came in at 2.4% year-over-year inflation. 2.7% was expected. In fact, that 2.4 is a bit of a misnomer. If you break it down into the monthly number, it was up 0.17 month over month. And if you do the math, 0.17 times 12, y'all, we are right at 2%, 2.0% annualized inflation. That is exactly where the Fed has targeted for in our inflation read. That's what they want to maintain. Well, they've got it. So we'll see if they act on it. We've talked about this numerous times on previous videos that this Chairman Powell Fed is not likely to act on the news, y'all. They are trying to, in his mind, I suppose, preserve the Fed's independence and not kowtow to the administration, and that's what a cut would be perceived as. So I don't think that Chairman Powell is going to be inclined to do it as long as he sits in that chair. But he only sits in that chair until May, y'all. And then the first meeting that we have in June tells a different story. So if you look at the CME FedWatch tool, which tracks Fed futures, we have a 10% chance of a cut at the March 18th meeting, so we're not going to see one there. We have a 29% chance of a cut at the April 29th meeting. And then we have a 68% chance of a cut at Kevin Warsh's first meeting as chairman on 6/17. So, y'all, I do think it'll be early summer before we see any movement from the Fed. And here's what I would caution folks, y'all. When you look into Kevin Warsh and you look at his positions that he has taken regarding the Fed balance sheet, regarding how he feels about quantitative easing, keep in mind that the Fed really only has two good tools for lowering interest rates. The first is they can lower the overnight rate that banks lend to the discount rate, it's otherwise called. That has a minimal effect on bond trading, y'all. It does send signals to the bond market that fixed incomes are more attractive. You see the Fed move to lower the discount rate, it does convey to the bond market that fixed incomes might be a better option. So it does in that way stimulate demand. However, what really moves the needle from the Fed is when they start buying mortgage bonds and when they start buying treasuries. That's called quantitative easing. That is what materially moves rates lower, and Kevin Warsh hates it. In fact, he doesn't like for the Fed to hold the amount of fixed income securities that it currently holds on its balance sheet, and has made it clear he would like to see those balances drawn down. Well, when those balances are drawn down, when those fixed income securities are allowed to run off the Fed's balance sheet, that puts more supply of fixed income securities on the market. More supply means lower prices. Lower prices means higher yields. Those yields are our rates. So we're going to have some competing interests here. It's very likely that Kevin Warsh is going to give us cuts in the discount rate. It's also very likely that his policy of wanting to reduce the balance sheet at the Fed is going to push rates higher. Those may balance out to a degree, but the point of all of this is, if you're looking for the Fed to materially move lower because Kevin Warsh is taking over, we may not see a huge move in that direction, y'all. There may be other reasons that we see rates moderate, but Fed policy alone is not likely to be it. So in any event, I wanted to throw that out there because there's a lot of folks that may be sitting on the fence and waiting, thinking that we're going to have a far more friendly Fed chair, and to a degree we are. We're going to have a far more fiscally responsible Fed chair, I can tell you that. And he's far more market-based in his thinking, which I applaud and appreciate. So I'm glad that Kevin Warsh is the one leading the Fed. However, folks looking for a huge drop in rates in June, not likely to see that, y'all. The point of all of that is, when you've got rates in the low sixes, most lenders, including us, are quoting rates in the fives pretty much across the board, y'all. We get more favorable pricing in Texas compared to the rest of the country. That's part of the reason. But bottom line is, waiting is an expensive gamble, y'all, because when these cuts start being announced, even though the market may not show lower interest rates, it is going to jostle a lot of buyers loose. So they're just looking for that headline that the Fed's cutting, and that until they start diving in. And when they do, you have a lot of competition. That's going to push prices higher of the products, of the houses that you're looking at. So just something to consider, y'all. A lot of merit into diving in now while you can get what you want. And if rates do drop considerably, obviously you can refinance that. So I know that's a common theme on this call. It's going to continue to be, y'all, because it's just the truth. Hate to see folks waiting and then miss out either by not getting the house they really want or having to pay too much for it. So in any event, hope this is helpful for you and for your clients. Feel free to share this. We're always honored to have your referrals. Stay blessed. Stay safe. We'll talk to you next week.